you have store credit somewhere, and like let's say like you have $20 worth of store credit at or like on Amazon, then like if you buy something that's like $15, then they're not going to like charge you because you have the credit for it. So the credit's kind of like, if you have $20,000 worth of credits, then they're not gonna like, they're not gonna charge you, they're not gonna tax you on those $20,000. So they work really similarly to a deductible, but you can get credits on all kinds of things. So again, like if you have a home, if you have children, paying on mortgage interests, if you adopt, and then if you are disabled or retired, and stuff like that. Okay. So capital gains. Capital gains are when you have an increase in the total value of a capital asset. A capital asset is basically an investment, so like real estate or stocks. So if you buy a house and then you fix it up, or you make the total value of the house go up, and then you sell it, that'll be called a capital gain because you made a profit, and you can be taxed on that. However, conversely, if you buy a house or something and it loses value over time, and then you sell the house then, that'd be capital loss, and you can also be taxed on that as well. So, it can be kind of punishing, so yeah. However, so gains and losses are not recognized until the thing is actually sold. So if you have a house and you like lose value, according to like the assessor says that your house has less value than it did when you bought it, that's technically not a capital loss until you actually sell the house. So yeah, you're not going to get taxed on those losses until you actually make the choice to sell it. Capital gains are taxed lower than regular income tax. That is to like it's the government's way of trying to get you to invest in things like houses and stocks. So yeah. Okay, so property taxes. Property taxes are paid to your local government, so county or city stuff like that. So property taxes are assessed by the local government, and the taxes are paid by the owner of the property. The tax is usually based on the value of the property, which includes both like the land and then any structures on it. And then the local government can use those taxes to like fund like local needs, so like water improvement, law enforcement, any service that they deem necessary. So property tax rate in the U.S. compared to other countries is quite a bit higher. And then to find how much money like if you owe to your county government based on your property tax, you just multiply the property tax rate by the market value of your house. When you're talking about property though, it doesn't include personal properties, so like, furniture, appliances, clothes, none of that is calculated into the market value worth of your house. So estate taxes. Estate taxes are paid to the state government, or the federal government. They are levied on people who, when an heir inherits a portion of an estate from like their father or mother, anyone, the estate they inherit can be taxed. Almost everything can be taxed. It doesn't apply when a spouse leaves it to another spouse, but it's only when an heir. Estate taxes, the nice thing is that they only apply,
Isn't there a rule that if you gift money at like the $10,000 section or something, it won't get taxed? Like, is that a thing?
Sort of. I'll get into gift taxes in a second. And so the last main thing is estates worth only $5.45 million or more can be taxed. So, if an estate's worth less than that, then it can't be taxed. So, there is some leeway and stuff. So gift taxes, they're like estate taxes, but basically to prevent people from giving their home or like their estate away during, like, while they're alive to an heir, to like prevent having to get their heir get taxed when they die. The government made these gift taxes, and they work pretty much the same way. It's really just a countermeasure to stop people from trying to, like if someone's on their deathbed, is trying to like stop people from giving away all their property before they die. Okay, so bonds are they're a fixed income investment in which someone lends money to an entity. It's often a government, but it could be a business too, which borrows the money for a variable or a fixed interest rate. So bonds are used to like raise money and finance projects and activities. Entities can issue bonds instead of taking loans from banks. All they do is they issue the bond that states the interest rate and date at which the bond has to be repaid. The bond price depends on like the credit quality of the issuer and like the length of time until the bond expires. And if someone buys a bond and receives interest payments, those payments are taxable as income. However, many municipal bonds, bonds issued by cities or countries, are tax exempt. And the government does this to try to promote people to actually invest in those bonds. Okay. Yeah.
So most taxes just seem like government incentives, like to make people give, like help out the government even more. Like besides the point that like the mandatory ones, like a lot of these just seem like it's like we want you to like support local government, and we want you to like support the federal government and stuff like that.
Yeah, a lot like because they don't want taxes to like literally just be a burden.
Yeah.
They want them to like, and I assume, I guess I can't really speak for the government, but I assume that they do things like this to try to, they use taxes because they are useful, and the government does need them to help people, like, provide law enforcement, stuff like that, with stuff that we need.
Yeah.
But they try to like make it more appealing to everyone by saying that at least it goes somewhere useful, and they can try to like, with tax exemptions and deductions and stuff, they can at least give you some sort of benefit from, paying your taxes.
Yeah.
Okay. Okay. So, last, I just wanted to have a quick discussion. I hope some of you guys did the reading or anything. And I was just curious what you guys thought were the, what were your own opinions and thoughts on the progressive tax rate versus a flat tax rate, and whether or not you think it's fair for, people. Either.
I think that would make sense, because like,
Which does?
the progressive, someone who can't afford it shouldn't have to pay as much as someone who can, and it's like, the higher percentage will mean less if you have more money, like it will affect you less. What, if you're like living paycheck to paycheck, paying 20% or 37%, that's a big deal, but if you're not, then that doesn't actually affect the daily life all that much.
I would just question, how much does the, like, what you're talking about if you have a kid or if you're married affect how much you're taxed? Is it really significant?
I think it depends more on like your actual like income, because I'm sure that like someone who has a really high income, it probably wouldn't be affected.
But if you're like struggling to get by and you have 2 kids. Like,
Yeah, I mean, it really is meant to lessen the burden, because some people, that's kind of why we use a progressive tax system, is because people that already live paycheck to paycheck, if we tax them really highly, then you kind of be pushing them further and further and widening the gap. Yeah.
Like what I got from it more, besides the fact of like progressive versus flat, is just how like messed up their deduction system is. Like I did a little bit more research, and like there's people who like create free museums that are only like in their own property, so like it's closed off to the public, but it's technically like charity. Or people who can like say that their yacht counts as a property to get like deductions from that. So I think regardless of like progressive or flat, there's like always a way for the rich to come out on top.
Yeah, definitely. Luke?
I think it's also like connected to political ideologies in a lot of ways. I think that, or is this a progressive one which is more sort of involved with the government and such?
Just like another point is that I don't know if this is actually directly related to the flat tax versus progressive system, but it kind of seemed like the article was implying that it was, that the progressive tax system will either has in our country or inevitably will result in a system that is extremely complicated and has lots of tax credits and deductions and stuff. And it seems like tax credits specific, I guess deductions make sense, especially when talking about if you have a family, but it seems like tax credits specifically seem like a way for the government to incentivize, to reward certain groups of people and not reward other groups of people. And maybe that's not a good, maybe we should have our tax system separate from power, systems that are supposed to exert power over people.
Yeah.
And I think another point is that just because it's so complicated, I know that a lot of people, you can, if you hire a really good is tax attorney the right word? Yeah, or accountant, that you can actually make your taxes much lower by exploiting different kinds of credits and deductibles and stuff, and that could be a form of inequality, that creates more of inequality, that the rich people who can afford a really good accountant have to pay less, and that if we had, I mean maybe they still pay more than they do if it was a flat tax system, but I would imagine that if it was just a flat tax system, it would be a simpler system and less easy to do that.
I encourage you guys, if you don't, to talk to your parents about them filing taxes. It's really interesting, and if they have accountants, like Oliver was saying, accountants are trained to do it, and they can find all sorts of exploits in terms of the tiniest little credit or deductible, stuff like that. They can find ways to benefit you for the smallest thing. So yeah, it's interesting.
I would say, I think that the credits and deductions are, so it's a semantic thing, but I think that they tend to be more about rewarding or encouraging particular behaviors, not necessarily people, just for them being who they are. It's so something like having children and giving, and so I looked it up. So the child tax credit with the new tax law is going from $1,000 per child to $2,000, which isn't a huge amount of money. I mean, it depends on. That's what you don't. So that your taxes are reduced by that much.
Yeah.
That's being a tax credit. So for somebody who makes lots and lots of money, that's not a huge amount. If you only make $20,000 a year, that helps a lot, right? And the idea is that having children is good for society, so we should reward having children. I mean, that's a particular ideological.
I feel like the children one is I don't know. I feel like that might be an exception to many other different tax credits. I don't know very much about tax credits.
So things like being deductions for charities. The point is to incentivize giving to charity, right? And the deduction is, it's not that. So if you give $1,000 to a museum, you still are paying most of that. It's just that your income goes, for tax purposes, income goes down by $1,000.
Yeah.
So you don't have to pay whatever your bracket is, your 25%. You don't have to pay the 25% of the $1,000. So you give $1,000 and you get back $250.
Yeah.
So still, it's not like making it so that you're making more money than you would have if you hadn't given to the charity. It just makes it it just gives you a little nudge to give to charity.
Mm-hmm. I think you've chosen. I'm sorry. I feel like you've chosen two examples that everyone's going to agree with: is having children and giving to charity. Or I don't know if everyone's going to agree with having children, but I think my main objection is the idea that we're using our revenue raising system to incentivize certain types of lifestyles, and I think charity is there's not really any debate. There's no debate on whether giving to charity is good or not.
I think I don't know. So you got to come up with some examples of things that shouldn't. I don't
know any.
Because things like job hunting expenses are deductible. If you're out of work and you have to pay to drive across the country or fly across the country to go to a job interview, you can deduct that the cost of the flight.
I don't know any examples of any tax credits.
But I think it's ultimately, again, it's about access. I agree with you, it is about access to power, right? And I think people who have money have always found ways to have access to power. I mean, in our case, it's like a really complicated tax code where like people lobby right and left for like different deductions, right? And if you made a flat system, people who have money would find another way to, there would be some other way that they could, they would park it in a foreign country, in a foreign bank account, they would like whatever. But ultimately, people are gonna protect their money, right? And nobody wants it, I mean, that's the interesting thing, is that people all agree, I mean, assuming your tax money gets spent wisely, right, which gets managed wisely, which is another complicated topic. I don't know a lot of people who, gladly pay taxes. I mean, that's not the, people want to take as much money back as they possibly can because, they feel like it's their money. I think your point is well taken, that this is encouraging loophole and all kinds of weird ways of accessing power. I think it happens no matter what. Because that's human nature, I think. Like, that's my opinion, but, because it's true, like, it's interesting, like, so France has a progressive tax system, right? Where you have to declare everything, so pretty much your government makes your taxes and send you the bill. Like, that's what happens in France. And only if you have like really complicated taxes do you actually calculate anything yourself. Like, the whole idea that you are voluntarily reporting your income to the government is like, that's an American construct. Like, I don't know any other country that does that. Everybody, all the countries that I know in Europe, the state knows exactly what you're making, and they send you a bill for what you're paying. Not like, it's crazy, the idea that people are going to report voluntarily, oh yeah, I made that much money and he's taxing me. Like, that's crazy. So I don't know, it's interesting, it's complicated.
Okay.
Thank you so much, great presentation.
Thanks, Mr.
But not least.
Hi.
Do you need to use my computer?
Yeah, I'm gonna
Please.
send it to you. My computer will wake up. Come on.
How much time is it?
How much time was that? That was.
So, while Shay's getting set up, I'll,
When you started the discussion, you were exactly at 20 minutes.
two things for people. One, to more on Oliver's question about deductions. According to H&R Block, the 5 most common deductions are retirement contributions, so encouraging people to save for retirement, charitable donations, mortgage interest deduction, which encourages people to buy houses, which that's something you could debate whether that's a good thing to be encouraging or not. Interest on college education expenses.
That's a good thing.
And self-employment expenses. So if you work, the money you spend for your job, you don't have to pay taxes on it.
I was thinking
Business
tax
lunch.
credits, but maybe you were.
Do you need help with something?
Tax credits.
Put it on the business.
I filled out a form for like a taxes for doing like the deductible, and if you wish, mostly just like, oh, are you married to anyone? Are you self-employed or something like that?
I still haven't signed up for the draft.
And it didn't seem like there was.
So there's like, yeah. So credits are things that you just don't have to, like, it just reduces your tax amount by. So for instance, teachers, if they're paying for classroom supplies out of pocket, they get like $250 a year you're allowed to.
Oh, that's not
I have no idea where to stand. Okay.
Okay, time for